Okay, thanks Ingrid. The RBA followed the script and left the cash rate at 2.5%, which is a 53-year low. And the big difference between their last two media releases was the fact that a reference to a high dollar was dropped. Now, this is significant as this was the main reason why the big bank might have risked adding to house price increases by cutting rates again. Lower rates would have helped get the Aussie dollar down to the 80 cents region. However, the RBA might be punting that when the Yanks start tapering, this will push the green back up and our dollar down. In addition, I think the bank likes what it is seeing with business and consumer confidence and therefore could be willing to risk no more cuts, but it will be watching local and overseas economic data and the market reactions to the odd things like the US government running out of money. Only in America. On that stupidity masterminded by the US Congress, it is worth noting that the last time this happened in 1995, where Bill Clinton and Newt Gingrich were fighting over Medicare, education and environment, when it ended after 28 days, the Dow shot up about 600 points in 3 months. Putting this history with the improving US economy, taking a line through the latest ISM manufacturing numbers, it tells me this latest sell-off is another buying opportunity. God bless America. Okay, house prices in capital cities soared to record heights last month, stoking concern that record low interest rates are fueling overheating in the country's property market. RP Data's Rismark September index rose 1.6%, the fourth consecutive monthly increase. The annual measure edged higher from 5.3% to 5.5% per year, and that's the fastest annual increase since late 2010, remember, when the whole world was nearly falling apart, so that's not a big deal. For more, we're joined by Cameron Kusher from RP Data. Hello, Cameron.
Hi Peter, how are you?
Great, mate. Now, it all sounds terrible when you start saying the highest increase since 2010, but there were a lot of scared people around 2010, weren't there?
Yeah, there certainly was, and to put it in perspective, we've been seeing, until about the last 12 months, ongoing falls in values since October of last year. So we're only now just getting back up to that previous peak, and if you actually break it down city by city, it's only really Canberra and Sydney where home values are now back above their peak. If you look at a market like Brisbane, for example, or Hobart, home values are still about 10–11% lower than where they were at their peak. So although we talk at a macro level about what the index is showing, if you look at the individual capital cities, you'll see that a lot of them actually aren't doing that well and still have a long way to go, even just to get back up to the previous peaks.
So for a guy like you, Cameron, who spends his whole waking hours thinking about housing prices, I'm sure you must get in trouble with your wife all the time thinking about housing prices. When are you going to get worried about a housing bubble?
Look, what we're seeing at the moment is really quite strong growth over the last quarter in Sydney and Melbourne, 5% growth, about 5% growth for both of those cities. But it's only really just starting, and Melbourne values are still lower than where they were at their peak. If this kind of level of growth continues to go for 12, 18, 24 months, then that's when we really need to start getting concerned. Obviously, there's been a lot of commentary lately about the potential for a housing bubble to form. I don't necessarily think that the rate of growth we're seeing at the moment will continue. Obviously, the federal government thinks that unemployment's going to rise higher from here, and there's a myriad of other economic factors that will play into what happens with house prices, but you can't just take a month or a quarter worth of data and extrapolate that forward and say, you know, in 12, 24 months' time we're going to be in trouble, because the market's very seasonal, and just because we're having a strong quarter at the moment doesn't mean that it's going to slow down significantly next quarter. Okay,
well, you made references to different capital cities. Do you want to run around the country and give us a perspective on what is sort of the price momentum in those key cities?
Okay, no worries. So if we start with Sydney, obviously that's the market that we're seeing real strength in at the moment. Over the last month, we've seen home values pick up by about 2.5%. And over the last 3 months, they're up by about 5%. So clearly there's some strong momentum there, but most of the lead indicators have been telling us that anyway. Auction clearance rates have been very strong, up around 80% regularly on a week-to-week basis. We're seeing sales volumes pick up as well, and given that the market's only recorded capital gains of about 2.5% per annum over the last decade, it's no real surprise that that market is responding in this manner when we've got interest rates at such low levels.
Yeah, can I just emphasise that for people who watch this program? So Sydney's per annum increase over the last 10 years has been like 2.5%. It's hardly the preconditions for a housing bubble, is it?
That's exactly right. And if we have a look, it's actually been a little bit stronger over the past 5 years, but for about 5.5 years, from late 2003, early 2004 up to 2009, home values had moved nowhere. So clearly it did overshoot the mark a little bit back in late 2003, early 2004, but instead of seeing a massive collapse, we just saw a sustained period of no growth in values. And if you think of the fact that the Sydney housing market's underperformed inflation and wages growth over that period of time, obviously the cost of everything else has increased relative to the cost of housing, which hasn't moved.
So what about, say, a city like Perth? Because it was a boom town. Is it still booming, or is it going off the boil?
It's certainly going off the boil a little bit, Peter. If we have a look, even 2 or 3 months ago, the Perth housing market was growing at an annualised rate of about 9 to 10%. Over the last quarter, we've seen very little growth in the Perth housing market, with values falling by 0.1% in September. And I think what we're seeing there is obviously the mining investment peak has now passed, and the West Australian economy is obviously fairly heavily reliant on the mining and resources sector. Now, if people aren't investing in the mining and resources sector as strongly as they were previously, that means that demand for engineers is not as strong as it was 12 months ago. Demand for surveyors is not as strong. Lawyers don't have the same number of contracts to write up, so that is going to put a dampener on the housing market there. People are going to show less preparedness to go and buy a house if they're not as confident about their ongoing employment. So I think that's really playing a part in the Perth housing market at the moment, and we're seeing some weaker market conditions, and they may continue over the coming months.
Now, what about Adelaide?
Adelaide, not seeing much happening there. If we actually look over the last 12 months, home values in Adelaide are down 0.8%. So the market's not really responding to these lower interest rates, even though you might think it should, given that over the last 5 years, home values in Adelaide have only increased by about 1%. But of course, Adelaide and Brisbane, to a lesser degree, tend to lag what happens in Sydney and Melbourne. So maybe that sustained period of underperformance in Adelaide and the ongoing low interest rates, we'll start seeing some improvement in that market over time over the next 6 to 12 months.
Okay, so let's go to Melbourne, then we'll wrap up from there.
Yeah, well, Melbourne, if you have a look at Melbourne, home values over the last quarter are also up 5%. Melbourne's a bit of an interesting one because we're seeing obviously a lot of investors ploughing into the Melbourne housing market at the moment. But if you look at the rental yields in Melbourne, they're the lowest of all capital cities. So I hope that those investors are chasing the capital gains and not relying on that rental return, because a gross rental return of about 3.6% for a house, once you actually figure out the net rental return, it's not looking particularly attractive.
What?
Now, the Melbourne housing market hasn't seen a period of sustained correction like we've seen in Sydney, like we've seen in Brisbane and Perth. So I'd probably be most concerned about the Melbourne housing market. Once interest rates do start to get lifted, I do wonder how sustainable this current recovery we're seeing in home values is in that market.
Okay, mate, so what's the best city for yield, net yield nowadays?
If we're looking at net yield, I mean, we publish gross yield, and but if you're looking at the gross yields, you're getting about 6% in Darwin, but we are seeing capital gains in the Darwin housing market come off the boil a little bit, much like Perth, and I think it's largely the same reasons as why we're seeing a slower level of capital gains in Perth as why we're seeing in Darwin, obviously fairly heavily linked to the resources sector. But outside of that, in Brisbane, for example, units are getting a gross rental yield of 5.6%, so your net return's probably going to be about 4.3, 4.4%.
Yeah.
Obviously, you're not getting much in the way of capital growth in the Brisbane housing market yet, but again, I think the prospects for Brisbane, having seen no capital gains for the last 6 years or so, are starting to look a little bit more positive, particularly if we see interest rates remain at these levels for the next few months, like I think most people think we will. Okay,
so looking around the country just briefly now, if someone's looking to go into the investment market, is it houses or units that have the best prospect?
Well, from a rental return basis, your units typically enjoy a stronger yield, but if people are chasing capital growth, we're finding at the moment that houses are outperforming units. And over the last 12 months, houses have increased in value by about 5.5% compared to units at 4.5%. So it really depends on the strategy. And I think more and more investors at the moment are really focusing on total return. If we look at the boom in prices between 2001 and 2004, people didn't have to worry about their rental return because they were getting that capital growth. But now that the expectations are that capital growth is not going to be as strong as it has been in the past, people do start to need to consider about the rental return they're getting with their property as well. So the best opportunities, as I said, units in Brisbane, houses and units in Darwin, and some of the unit product in Canberra is also yielding quite nicely at the moment.
So if someone goes to your website, mate, are they able to find out what are the best suburbs, for example, in Brisbane, where the yield is and where the capital gain is?
Yes, that information's all available from the MyRP Data website, so there's plenty of information, and you know, it's a great tool for people to go and have a look and figure out what they should be buying and what sort of rental return they can expect, what sort of long-term capital growth those markets have got as well. So there's plenty of resources out there on the internet. Okay,
well, I know you're not tipping it, but from listening tonight, I think Brisbane looks like a nice bet over the next few years.
Yeah, I think certainly that the Brisbane market fundamentally is looking a lot better. And when you consider that home values are growing so strongly in Sydney and Melbourne, the lure of Brisbane was always the fact that it was a lot more affordable than both of those markets, and that gap in affordability is really starting to widen again.
Okay, mate. Thanks for joining us on the program. Very insightful. Thank you.
No worries.